All right, everybody. So deciding whether to refinance your house can be a tough decision, and there are a lot of things that go into it. It's a decision that I have contemplated on numerous times, mostly because I'm an accountant, I'm a numbers nerd, so whenever I see rates go down, I see that as a possible opportunity to refinance my house and to save some money. So in this video, I am going to do a breakdown on how I make the decision on whether to refinance my house. My whole goal in refinancing my house is to pay down my debt quicker. And I never over leverage myself, so I never pull out so much debt that it makes it hard to make that monthly payment. Too much debt is a bad thing. So if at all possible, I would say only have debt on your house. Obviously, sometimes that is not possible because some people need to have debt to have a car. But if at all possible, it is nice to pay cash for a car and only have debt for your house. So like I said, my goal is to pay down my house as quickly as I can and to save money on the interest charges that you have over the life of the mortgage. If you are considering refinancing your house to pull capital out, the only thing that I would warn you of is just make sure that you understand that your mortgage at that point would start over. So you'd either start back over at a 15-year term or a 30-year term. Also, I would just tell you to be very, very picky about what you use those funds for. There is just a whole lot of peace and happiness that comes from knowing that you don't have debt. So let's jump right into it. Whenever you are pulling out a mortgage with a bank or a lender, there are costs associated with those, and those are often referred to as closing costs. Closing costs include the appraisal, a title fee, some underwriting fees. There's a bunch of little things that go into it. So you will always have costs associated with opening a loan. So I'm going to show you a very quick and easy way to decide whether or not refinancing your house is worth it. I actually did it recently on a house that I own. My mortgage is $910 a month. And when I was going to refinance, it ended up being that my payment was going to be $826 a month. Now I had just started the $910 a month mortgage about 2 years ago, so it would be adding 2 years back onto the term. So instead of having 28 years left on that mortgage, I was going to have 30 years left on that mortgage, and that would be a savings of $84 a month. That is $910, like I said before, minus the $826, which would be my new payment. So I would have an extra $84 a month to be able to pay on that mortgage. My closing costs, or the costs associated with pulling out the new mortgage, was going to be $3,117. So in refinancing, you can either pay your closing costs in cash, or depending on your lender, you may be able to finance that, or just, in other words, put that on to your mortgage. So in my head, I think of it this way. If it takes me $3,117 today to be able to refinance my house and have a lower payment, that saves me $84 a month, how quickly is that $84 a month going to pay me back for the money that I have to invest today? I view that as a payback period. It's almost like an investment, right? Where if I put money in, how quickly does it take for me to get all of the capital that I invested back? And in this case, it takes 37 months. So just over 3 years in monthly savings of $84 a month to make back that $3,117 that I had to invest to refinance my house. So that calculation is super, super simple. You take $3,117 divided by your monthly savings cost, which is $84, and you get 37 months. So then at this point, you just need to decide whether or not you are going to be in that house for 37 months. If you don't think you're going to be in that house and you're going to sell, then the cost up front, that $3,000, may not be worth it. But if you're going to be in that house for a long term, then you might say, okay, if I'm going to be getting my money back in 3 years, and then after that, my monthly savings is going just to come to me, then it may be worth it. But this is a quick and easy way to decide whether or not refinancing is worth it. Another thing that you may want to consider is if it extends your loan by a significant amount of time, then you may be incurring more interest over time. So, for example, if you're like 8 years away from paying off a mortgage, but you decide to refinance it and refinance it over 30 years, well, then you're going to be earning interest or being charged interest on that loan amount for 30 years rather than 10 years. So that may impact your numbers. But in my head, a way to just cancel out that analysis and not have to worry about it is if I refinanced, I went in at a lower rate, my monthly payment dropped from $910 down to $826. Like I said, that's going to save me $84 a month. If I took that $84 a month and just kept paying it down on my mortgage, then I would actually pay down my mortgage quicker. I would have the exact same monthly payment, but that $84 a month would be going down onto the principal of my house. Just like I said before, my whole goal is to pay off debt as quickly as possible. So if I refinance and put that money on, I will pay down my house quicker. And it's simple math. The more that you have down on principal, the lower your principal is, then the lower your interest charges. So I would be saving money on interest over time. Refinancing a house can be a little bit stressful, but if you just break down the numbers and look at it just by numbers, it takes a lot of that stress away. So as I said before, take your closing costs, divide it by your monthly savings, and then see how long it's going to take to make that money back. And then you can decide whether or not refinancing is worth it. I appreciate you watching. If you found this information useful, please consider subscribing to the channel. There'll be a lot of content, a lot of personal finance stuff coming in the future.